The EG trigger point is a cloud-based indicator. It produces key levels daily, and these levels are delivered to our customers 10 hours before the market opens. And these levels are fixed and they do not repaint. So, how to use it? How to use the trigger point? Before I share my own strategy, guys, let me briefly present our paper titled Beyond Liquidity. It contains many chapters. We tried to explain this algorithm, and when we developed the algorithm, we described the problem formulation as follows. Our algorithm aims at pinpointing exact significant price levels, and these are prices where the behavior of the market is more expected and less random based on several features, based on deep market and historical market data. And this means that when the market respects a level, the drawdown is statistically minimized. That's what the trigger point algorithm attempts to do, to provide you with opportunities while minimizing the risk of volatility and liquidity grabs. So briefly again, our algorithm aims to provide opportunities while minimizing the risk of liquidity grabs. So how to use the trigger points? We know statistically that the market tends to bounce back when it reaches the levels for the first time during the current trading day. This is what we call the first touch rule. But if not, I will show you how I manage the risk more effectively. The first touch can be relative to the current trading day, current session, or ATR based. So in this example, this is the first touch, and this is the first touch, and then we saw there was a big movement here, big ATR. So considering this movement, the ATR, this can also be considered a first touch. Okay, so we have the first touch relative to the current trading day, or each time a new session opens, we can consider the next touches as first touch, or it can be relative to the market movement, the distance relative to this level, and when it got back, this can also be considered the first touch. So I considered the first touch rule according to the definition, but I always complement it with a confluence method to increase the probability of success. And by confluence, I mean it can be either by filtering out lines that do not provide you with A+ setups, or confirming lines that provide you with A+ setups. Okay, so remember, confluence is about avoiding bad entries and confirming good entries. This is the way you can get profitable. This means that if you're confused, the market is weird, the levels are weird, no trades. So confluence can be either by filtering out lines without A+ setups, or confirming entries when you see A+ setups. Okay, so we consider the first touch rule complemented by a confluence method aiming to avoid bad entries and to confirm A+ setups. But how? How to identify A+ setups? How to avoid bad entries? How do I know about bad entries ahead of time? How to identify A+ setups? How to avoid bad entries? And how to know about bad entries ahead of time and not after the fact? or maybe understand that the entry was bad while in an active position and exited the position with a small profit. It's also a good option because sometimes you only know about bad entries after the fact, but you're in green, in a small profit. And by reading the price action, you understand that the market wants to break and you get out with a small profit. Okay, so you want to identify A plus setups ahead of time or exit the position with a small profit if you identify by the price action that the market wants to break. Ahead of time or after the fact with a small profit. So again, we have our significant price levels with a high probability of market reaction. We want to add more confluence and get more confidence in our entries. Confluence is about confirming good entries and avoiding bad entries. Both are important, guys. In other words, identifying A plus setups and only trade on A plus setups. Guys, your way to improve your trading accuracy starts with significant price levels. These are price points expected to drive the market reaction, like our trigger points. And thus, understanding the price action, identifying A plus setups become much more easier. So the first is key levels. The second is understand that statistically the market tends to bounce back when it reaches significant price levels for the first time during the current trading day. Then you complement these two building blocks with a confluence method. And to remind you, the definition of a first touch can be relative to the current trading day, current session, or even after the price made a big move and got back to the level. So in those cases, these can be considered first touch. So the first is key levels. The second is first touch rule, complemented by a confluence method. Confluence is about avoiding bad entries and confirming good entries. Remember, guys, this is all you need. 3 components: significant price levels with a high probability of market reaction, understanding the statistics behind these levels, the first touch rule, complemented by a confirmation method, identifying A plus setups. And identifying A plus setups becomes much more easier on significant price levels. So significant price levels come with a system of expectancy. Remember, guys, we expect that the market will bounce back. We buy at support since we expect the market to go to the upside after it touches the level. We sell at resistance since we expect the market to go to the downside, and we expect that after the level breaks, the market will retest it and then bounce back. So key levels provide you with a system of expectancy. Guys, this is the key of trading. Significant price levels provide you with a system of expectancy. We expect the market to bounce back. Did not happen? Here is where the risk management comes into place. After it breaks, we expect a retest and a continuation. Why? Because support turns into resistance and resistance turns into support after the break. Guys, this is the system of expectancy. And Confluence makes our system of expectancy sharper. It aims to increase the likelihood that our expectations will hold. So, significant price levels provide you with a system of expectancy, meaning we expect the market to bounce back. And if not, meaning if it breaks, it provides with another opportunity with a high probability. And Confluence is about to increase the likelihood. Likelihood of what? Likelihood of avoiding bad entries and confirming good entries, identifying A+ setup. Like, avoid entering on first touch rule if the market is going to break, this is what we want, or to confirm a line break to take the opposite side. It's also the confirmation we are looking for. Guys, mastering key levels is all you need to be more successful in your trading and consistent. An A+ setup is about to increase the likelihood. Now, our trigger points provide you with, our trigger point service provide you with fixed non-repaint key levels ahead of time with a high probability of A+ setups. So, how to trade them? How to identify A+ setups? And now, guys, we are going to talk about Confluence methods. There are two types of Confluence. The first is avoid bad entries, and the second is confirm good entries. One way to avoid bad entries off significant price levels is by reading the market acceleration. Remember, guys? Identify that even though the market struggles to break, but it tries to, leading to a sudden move. Support level was validated, respected several times, the more the market visits a level, the weaker it becomes. So, reading the market acceleration is one way to avoid bad entries. The second is understand that the more the market visits a level, the weaker it becomes, and now you understand why, if you consider the pending orders and the sellers or buyers, it depends if it's a support and resistance. The third is my favorite, utilizing correlation, correlated assets, my favorite method, since it does not lag in most cases. For instance, NQ and ES. They are highly correlated, and this is the way it can be utilized. Mastering correlation, guys, and I invite you to subscribe to our YouTube channel as we post many examples of mastering correlation to identify A+ setups. Guys, in my approach, it's relative to significant price levels. So correlation, utilizing correlation in my approach is always relative to the behavior of the markets to their price levels, relative to the trigger points. Examples. First, again, it's always relative to key levels, significant price levels like our trigger points. Let's say ES broke its resistance, became support. Now NQ reaches its resistance at the same time that ES respects its support, or maybe a few seconds or minutes later. ES and NQ disagree in this example because when the market reaches the support level, we expect it to go to the upside and resistance to the downside. This is our expectation from ES and NQ, and since they correlate, they disagree in this example. So ES respects its support level, we expect it to go to the upside. NQ reaches its resistance, we expect it to go to the downside. So they disagree. Confusion, no trades. Disagreement, no trades. Why? Again, because they are highly correlated. And if they disagree, this means that one of them will break the level. ES respects its support level and NQ reaches its resistance level. I would avoid shorting NQ with 100%. Confusion? No trades. Remember, guys, we are here to avoid bad entries and to increase the number of good entries. Scenarios with a low probability of market respect, market respect, like news and market opening, ways like utilizing tools and their opposite signals, meaning the market reaches a level, it's the first touch, but the divergence tool indicates the opposite side, meaning it produces with an opposite signal. This is also disagreement. It's a disagreement between the price and the signal, the price relative to the level and the signal. So basically, opposite signals can also prevent trading of key levels. Okay, so and how to confirm good entries? Let's take the correlation case. ES broke its resistance and became support, so avoiding shorting NQ, but then NQ breaks its resistance, retest it. So both agree at this point, I will buy NQ. Okay, so when they disagree, I avoid the trades, and when they agree, this is an A plus setup for me to buy NQ. So correlation for good entries is about waiting for the leader to reach a significant price level, identify what it does, and expect a similar reaction on a correlated asset. Very important, guys, since it repeats all the time and it's a leading indication in most cases. Another confirmation method is to utilize the first touch and identify a low acceleration. So first touch with low acceleration can provide you with A plus setups. And signals from tools that can identify the price action, like candlestick patterns, divergence, overbought and oversold like RSI, volume, fair value gaps. These can be used to confirm good entries of significant price levels like our trigger points. And in general, tools that identify the price action, divergence, candlestick patterns, traditional indicators, RSI, MACD, while in this case, avoid entries if such tools produce strong signals to the opposite, we can avoid this entry or confirm entries by aligning with what we expect. The signal aligns with our expectations. If it's a support, we get a buy signal from RSI and MACD. This can be also used to confirm the entries of support levels. Okay, so traditional indicators can be also considered when trading significant price levels. They can be used to confirm entries if they are aligned with our expectations, or avoid bad entries if they are not aligned with our expectations. But remember, guys, using these indicators has a high chance of success when the market is located near a significant price level. Key levels are the key. Now, I want to claim the following regarding significant price levels. For accurate key levels, almost every reasonable Confluence tool mostly align in positive cases and misalign in negative cases. Think about it. It's crucial since it has implications on the settings of such indicators. They can be much more flexible when considering near significant price levels. This means that when the market is about to reach a support level and it's about to respect this level, in many cases we can see it. We can see an RSI long signal or MACD long signal or divergence long signal. These traditional indicators, in many cases, agree with what we expect the market to do when it reaches a significant price levels. Guys, do you remember the system of expectancy? Significant price levels provided to you ahead of time provide you with system of expectancy. So it becomes much more easier to read the price action and understand where the market wants to go. So we have the levels, good reference to understand the price action, and we had a few validations. So at this point, we understand where the market wants to go. And as traders, we look for Confluence tools that provide us with practical, well-defined validation techniques. For instance, you can read the price action to identify that buyers push higher, or you look at a correlated asset to see what it does relative to its key level, or maybe you use traditional indicators or divergence tools to understand the price action. Now let's get back to your questions. The EG Trigger Point is a cloud-based service that provides you with fixed, non-repaint key levels daily, 10 hours before the market opens. So how to use the accelerometer, which is a great question. So the EGAI accelerometer measures the difference between ATRs, and it's time frame dependent. It can be used to identify line breaks. When between the thresholds, no line breaks are expected, and it can be also used to confirm entries on first touch rule. How to trade news. So guys, to minimize uncertainty in market reactions, we usually avoid trading during high impact news events, as price movements tend to be less predictable and may not respect key levels. But it really depends on your experience and trading style. In general, our system of expectancy is weakening, and the probability of A+ setups becomes much lower on high volatility events. A good method to trade prop firm. So this is a great question. Regarding the positioning, so it should be based on the permitted drawdown, guys, rather than simply focusing on the maximum number of contracts allowed. Also based on your mentality. For instance, for some traders, trading micros is much less stressful. Remember guys, patience pays. So you need to stick to your rules. You know, it was found that trading together in a community helps in sticking to rules. So, by the way, we invite you all to our live trading room and see how we stick to our rules. And rely on methods that work for you, that fit your style. Backtest and forward test. Avoid coin flipping. Identify tools that provide you with high probability setups. Clean up your noise, guys, and stick to the strategies that work best for you. Important metrics are risk to reward ratio, low drawdown, and accuracy. Confused? No trades. Wait for A plus setups. Don't chase the market. There are many opportunities every day. Now, I believe that A plus setups come when mastering key levels combined with Confluence methods, and we develop tools aimed to take the guesswork out of your trades, guys. Our trigger point and mastering Confluence methods like the EG Confluence tools and correlation methods. So my strategy to identify A plus setups is mastering our trigger points complemented by the correlation methodology relative to the trigger points, meaning if ES reaches its support level and NQ reaches its support level at the same time, this is an A plus setup for me, especially if it's complemented by a buy signal generated by our divergence on or confluence tools. So I confirm entries by looking at two correlated assets relative to our trigger points using the system of expectancy, and I avoid bad entries if I identify that correlated assets disagree relative to our trigger points. This is my method. So in the next lesson, I will discuss my strategy for identifying A plus setups in detail and how I take advantage of our automatic strategies.